All right. Sorry about that. That never really happens to me. I could go way off into the deep end and bad jokes on that one. Um, Sorry about that. I don't know what happened. It just out of the blue stopped. Um, the audio stopped. Uh, just to give everybody a heads up, I had to log out and log back in. The problem that that's going to cause is that it's going to break this into two videos. So tonight, when I do the rendering and posting, I might try to blend these together, but there's a very good chance that this session is going to be broken into two videos. Sorry about that. I apologize. But I don't know why it happened. All right, everybody good? Everybody back? Okay. Now, when we were talking about this, when I broke off, we were talking about how we're going to turn this into profits. Well, we need to look at the way the volatility is going to move, and we need to figure out two things. And this is typically the combination we get into every single time that we're dealing with this type of a situation. One thing is how do we make the money? And two, how do we protect ourselves while we're making the money? We can build a good edge into these trades. We can use the situation to create a very, very strong opportunity for us, but we need to pay attention. We need to be careful because just doing it blindly and stupidly can expose us to some very, very big risks that we don't want to take. So let's walk through a couple of things. Let's see here. First of all, if I were to take a look at the options here, yeah, this isn't a good one. Let me find a symbol that we can work with. I actually have a couple of possibilities here. It's a little tough right now because we're in this kind of dry spell right between two earnings announcements. I want to do an earnings style trade first. So let me just do this. All right, I'm going to work with Costco. Now, right off the bat, I just want to be very clear about something. I'm walking through this to teach you about the trade. This trade itself may not necessarily end up being the greatest trade, but the steps are the same steps that we would use every single time when we're dealing with this. We'll figure out by the end of the process whether or not this is a good trade or a bad trade. That's what we want to do. And, you know, it's amazing because sometimes it's not obvious and it's not actually clear whether it's a good trade or a bad trade. Not until you run the numbers and you actually do the work to figure it out. So let's dive in. Texas Instruments has earnings tonight. Let me just play with Costco for right now. We might work with Texas Instruments, but let's just work on this. Has earnings tonight? TXN? Nope. Target. Oh. Yeah. Actually, I think they had earnings this morning, didn't they? Yeah, that was this morning. We're too late on that one. Let's take a look at Costco. Let's just jump back to that. I think that'll work for us. I normally don't like it when the stock has moved up so fast, but this will give us a chance to explore the ideas. All right. First of all, we have an earnings announcement in Costco on the 2nd, and it is after the market closes. That is Thursday night. The options that expire the closest possible to that are the ones that expire on the 3rd. Excuse me. So let's play around with those. The March 3rd expiration options have an implied volatility of about 41% right now. That's pretty good. That's not too bad. Let me talk about this as a trade instead of a concept for a second. What we're going to try to do is we're going to try to use the collapse in implied volatility to create a situation that gives us a really good solid edge in a trade. We are going to be selling options that expire immediately after the earnings announcement, creating a short strangle. Those options are going to have a high implied volatility that's going to collapse down to a very low implied volatility tomorrow, or not tomorrow, but immediately after the earnings announcement. And we're going to use that to give us an edge. The problem with that trade is that it is a short strangle, and the stock could jump all over the place. Now, we do have a nice solid edge in the trade. We're getting an advantage in the trade because the volatility is going to drop significantly. Problem is that that drop in volatility could also translate into a great big huge price movement, and that is not what you want when you've got a short strangle. So we need to figure out a way to control that. Now, everybody here who's been a trader for a while has heard the phrase buy low, sell high, or sell high, buy low. You don't have to do it in any one particular direction, but when you buy, you want to buy low, and when you sell, you want to sell high. Well, right now we have the opportunity to sell high. On the other hand, if we go further out into the future and I look at some of the different expirations coming along in 2, 3, 4 weeks or so, you'll notice that the implied volatilities on these are massively lower than the implied volatility on this. And that's because these are not as at risk. There's a lot of time between when the earnings announcement happens and when these expire, giving the sellers plenty of time to manage risks and offset risks and do a bunch of different things that they might need to do to make themselves much safer. Therefore, the premium that they sell the options for can be lower. Now, this will be a little bit high. There's going to be a little bit of a value poked on top of this or put on top of this, but not that much. So if I'm selling high, buying low, this is what I'm doing. I'm selling the high-priced options, I'm buying the low-priced options, and I'm basically creating a trade that uses a squeeze between these two as these two drop back down into line after the earnings announcement happens. So let's go step by step on this and walk through how I would actually do this as a trade. And then I'll also explain what the idea is that I'm using to give me the edge. First thing, I need to basically create a short strangle. I need to think through what am I doing on this trade. I'm going to be selling short the put. I'm going to be selling short the call that expire this Friday. On this particular trade, I am completely 100% out of the trade by this Friday. I'm not holding on. I'm not leaving anything. I'm done. I'm out. I want to use strikes that are fairly close to roughly a 1 standard deviation point out from the current price of the market based off of what the market has for options pricing. Now, if you're using Thinkorswim, there's actually a really good way to get this. If you're not using Thinkorswim, I'm going to show you a little trick to get this. This number right here, $5.79. This is what they call the market maker move number. What it is just translating the prices of the options, or the average implied volatility, into a 1 standard deviation move number between now and the day that these options right here expire. So in 3 days, there's a 68.2% chance based on the pricing of the options that the stock will be within $5.79 above the current price it's at and $5.79 below the current price it's at. 68.2% chance. So that's 1 standard deviation range. So what is special about 1 standard deviation? A lot of the options pricing formulas are based off of what's called a normal probability distribution. And the 1 standard deviation point is a kind of interesting inflection point on that kind of bell curve that you're used to seeing. It bounces off the speed of which it's dropping off of, where it really starts dropping. It's kind of where it all rounds over and starts kind of moving in. There's a mathematical description of it, which I'm, to be honest, forgetting right now. As far as the pricing of the options go, it's an interesting point where it's kind of bouncing off the maximum drop in the value of the options versus the high pricing of the volatility, the premium. It's kind of, let's just put it simpler. It's roughly around what I would consider to be a sweet spot on the trade. It allows us to get the most bang for the buck. But that doesn't necessarily mean it's perfect. And there's a couple of reasons for that. Most of the time, when we're dealing with an earnings announcement, the market makers, the floor brokers, the professional sellers of options have overpriced the risk and elevated the risk or the price of all their options beyond where they believe they would actually be just purely compensating themselves for the risk. So we want to ride on top of that. We're going to use that to our advantage. And one of the reasons they do that is they know they can get away with it because there's a lot of people like long short hedge funds that desperately want to have protection against something really bad potentially happening after the earnings announcement. So this number right here in general tends to be a bit elevated. Now there's a second thing, and this is getting to my aggravation with Thinkorswim. You'll notice that $5.79 is right there, and it's right next to 41.53. Well, that's the implied volatility that Thinkorswim used to calculate out a $5.79 range, plus or minus range. If you actually take a look at the options around at the money are not 41% implied volatility. They're actually a lot closer to 33, 34, 35%. So what's happened is this number right here has been elevated. It's been artificially through two things. One, through the market, and number two, through the fact that they use bad math to calculate the number. This is too high. In general, I almost always want to work on the inside edge of this anyhow. But in this case, it's way too high. I'm going to trim it down quite a bit. Probably take about 50 cents off this. This is a little bit of a swag, your scientific-based wild-ass guess. You're just trying to trim it down a little bit so it's a bit more reasonable. In this case, I'm going to estimate that it's down around $5.20. Now, there is a little bit of a different way to get to this number if you don't have Thinkorswim. So let me show this to you right now. And I'm going to be kind of curious. My estimate is about 520, which should be a little on the inside of a 1 standard deviation range. Let's see what this other method gets us. All right. To do this, what you need to do is take a look at the price of the stock and look at the at-the-money strikes. Now, this is a little bit of an art, not necessarily a pure science. What you're going to want to do is make a judgment call. If you have this stock price, in this case 177.18, dead center between two strikes, halfway between 175 and 177.50. Let's just assume that it was 176.75. What I would do is I would sell short a put at 175 and sell short a call at 177.50. In this case, that's not really true. In this case, the price of the stock is 177.18, which is pretty darn close to 177.50. So what I'm going to do is I'm just going to sell short 177.50 and sell short, that was a 177.50 put, and sell short a 177.50 call. And the two prices come up to $5.63. Now you'll notice that this is moderately close to this right here. I'd still need to trim a little bit off of this because 177.50 is not the same as 177.18. But theoretically, if the stock price was exactly the same as the strike price I was using, the price of a straddle would be, a short straddler would be the equivalent to a 1 standard deviation move, dollars-wise, between now and the expiration of the options. So I can come up to this number, which is pretty close to this number, just by using the pricing of the options themselves. So did everyone kind of follow along? Yeah, Paul. So create a straddle and sell the put and call. That's exactly it. But I wanted to show everybody two different ways of doing that, getting to the same number using, an approach you can use on Thinkorswim, which is use the number that's there, or an approach that works anywhere. Okay. Now that we have that number, like I said, I'm trimming off a little of this, probably trim it off down to about 525, 530, 540, somewhere in that area. We need to figure out the strikes that we're going to work with. So we go back to the current price of the stock and we figure out our strikes. Let's see, where did my calculator go? There it is. So current price of the stock, 177.18. And I'm going to just use 525 as my personal number, a little bit on the inside. We might adjust that a bit. So 177.18 minus $5.25. 171.93. And 177.18 plus $5.25. 182.43. Great. Now, those are the rough areas that we want to be putting our strikes in. So let's go back and do this. By the way, the short straddle that we created here, we're not using it for anything. Don't think of that as a trade. It's just a tool to get us a number, the $5.63. All right, going back into this. I want to find a strike pretty darn close to 171.93. I have 170, which is quite a ways out, and I've got 172.50. A little bit tight. I'm not sure I'd be really excited about that, but I can work with it for now. So I'm going to take the 172.50. I'm going to go short on that. I'm selling the 172.50 put. This is below the current price of the stock. It's going to be the put side. On the other side, 182.43. Well, I have a 182.50. That's pretty darn close. That gives me my second leg. Now, I have $2 worth of credit between these two positions, 172.50, 182.50. Let's do a quick analysis of this and see what this trade looks like all by itself. And risk profile. By the way, anybody having any questions, things that just look confusing, anything like that? Because go ahead and fire them away. Hold on. There we go. I'd be happy to dig into this a little bit. This is a short strangle. Now, it's not a horrible trade. In fact, you paid, the amount of credit that you're receiving, it's a pretty high probability trade. There's a lot of good things about a short strangle, but there is two absolutely kill you, don't ever do this as a trade, reasons why you wouldn't use it. Number one is you see these legs that go down, actually they never stop going down, they don't curve at all, they're just one straight line down. Well, that represents an absolutely massive amount of risk. So as much as I might like this trade, as much as the trade might mathematically make sense odds-wise, it creates an opportunity for, I don't know, let's say the Costco comes out and says, oh, by the way, due to changes in blah, 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 we're no longer going to be in business. Now, I know that's crazy. It's not going to happen, and I'm not expecting it to happen. But I will flat out tell you this. During my career, I have had more than one hand's worth of times where things that I absolutely 100% guaranteed would have told you could never have possibly happened. If I didn't take trades that had limited risk and controls on them, I wouldn't be here trading right now. A trade like this, a short strangle, has the ability to completely wipe you out if that black swan crazy event comes along and causes the stock to move radically. Do I expect it to happen in Costco? Probably not. Could it? Yeah. Could it happen so bad that you don't even have enough money in your account to cover the cost and you have to sell your car and house to, basically get out of the, get away with it or to pay it off? Yeah, it could. I mean, that is a true, real thing. And by the way, if you dig around in your brokerage agreement, there's a whole section on exactly how and why they would do that to you. The broker will engage lawyers to come after your assets if you cause a loss greater than the money you have in your account. We never do that. Now, Bob actually nailed reason number 2. Because this trade is so damned risky, the brokerage doesn't want you to take it without putting up a whole lot of money to cover their butts. And by the way, margin is not anything about you. It's about them. It's about them asking you to put up enough money to protect them in case the trade goes bad. They are going to want a ton of money for this. So the margin on this trade is outrageous, which really ends up meaning that no matter how good the trade might be odds-wise, you just don't make much money on it because you've got to put so much money up to take the trade. So that's why we don't take these. We need to fix this. How are we going to fix it? Well, let's see what we can do. First of all, what's going to happen between now and Friday? Well, we've got $2 worth of credit, and as long as Costco stays between $172.50 and $182.50, we walk away with that in our pocket. Beautiful. Love that. Nice high amount of credit for a really, really short-term trade. Okay, let's figure out how to keep that just as much as possible. Now, I'm going to buy options. I'm going to go long. I'm going to take some of that $2 and I'm going to invest it into protection in this trade. I'm going to use the same strikes, but in this case, I'm going to go with long options. I know a couple of things are going to happen during this trade. After the earnings announcement happens, implied volatility drops. The short-term implied volatility is going to drop a lot. A little bit longer term, it's not starting off so high, it's just going to drop a little bit. All of these across the board are going to drop some. But when we get far enough out, they're not really going to drop much. And that's where things become interesting. We've got a couple of competing factors here. The further out in the future I use as an expiration, the higher the cost my protective options are. Now, that's my dollar cost up front. Doesn't necessarily mean what I'm going to lose on the options. It's what I need to invest to create the trade. So further off in the future, the price of the options are higher. I need to spend more, which basically means that the return on investment of the trade goes down. And I don't like that. Now, the flip side of that is, what's the real cost of protecting the trade? The trade is going to exist between now and Friday. Costco is going to have its earnings announcement the next day, which is the expiration of the short options. Those options are either going to expire worthless, or I'm going to close them out with a trade to close them. And at the same exact time, I'm going to close my long options. So this option that I'm buying to protect myself doesn't actually have to exist very long. I don't have a ton of theta erosion. I don't really have a lot going on. So if I sell this for almost as much as I bought it for, I keep the majority of my money. I don't lose very much. That gives me $2 worth of credit that I can make money with, and a little bit of money that I can protect myself with, my cost of protection. The biggest threat to this trade right here is how much does the implied volatility drop? Because for every 1% the IV drops on these options, for every 1% it drops, it hurts my trade and I lose money. If it drops too much, I could lose more than the $2 in credit I received. So we need to play around with that a bit. So the trick I use is this. I just go out and I look along the expirations. And by the way, we can tweak this as we go. But I just look along the expirations and I look for the point where the implied volatility basically levels out. So I'm dropping 41 to 26 to 23 to 21.8 to 20.35 to 19.78. You'll notice that the change between these is getting very small. There's not really a lot more of a drop. In fact, look at this. You go from 19.5 to 19.62. It actually goes up. Well, I want to try to find the spot that's as close as possible to right now, but has the least, it's kind of the closest to the leveling out point. For this one, I'm going to start off with the 24th of March. Now, we might tweak this a bit and maybe use a different one. That's roughly where things start to not be changing much. We might have to move out to the 31st of March. We'll see. Let's try the 21st of March, 24th of March first. March 24th. I'm going to use the same exact strikes. I need a, let me see, 172.50 and a 182.50. So 172.50. I'm going to go long. 182.50 long. Now, you'll notice that something changed. This went from a $2 credit to a $1.57 debit. Now, by the way, that's actually a really good indicator on this trade. If the amount of debit that I end up paying on the trade is less than the, basically the absolute value of the credit I received in the trade, that's usually a pretty good sign that this might be a decent trade. I'm paying a bunch of money for my long options, but remember, I do not intend to hold on to those long options for too long. I'm going to close them out this Friday. So I've got a little bit of theta erosion, and then whatever the implied volatility drop on those long options is going to be. Now, that's going to be an incredibly important thing in just a minute. But let's take a look at the trade itself. All right, get rid of this thing. We don't want that anymore. There. Okay. Now, first glance at this should look like an amazing trade. And it does. It looks pretty awesome. We're going to have to dig into it a bit more to make sure that this is actually as good as it looks. But let's poke around with it for a second. Why not April 7th or 21st? Actually, I'll tell you what, I'll show you a couple of things. But before we get there, before we get to that point, we need to figure one more thing out. Because none of this, we can't even make a decision as to whether or not any of these strikes are any good at this point until we know one very, very important thing. What is the implied volatility on our long options likely to go to after the earnings announcement? Now, this is where we have to put some work in. So, follow me on this. And also, I hate to say it, but this is where Thinkorswim really is an outstanding tool. I don't know of many. I know a rough way of doing what we're about to do, but I don't know of any really clear way of doing what we're about to do on anything but Thinkorswim. So this really does kind of push my point out. Get a Thinkorswim account, even if you're not going to trade it. All right. The beauty of implied volatility changes is they're very, very consistent. Now, sometimes you get some weirdness affecting the way the market works, but for the most part, implied volatility does roughly the same thing time after time after time after time. It becomes quite consistent. And that means that we can just go back in time and see what happened in the past and make at least a rough estimate out of what's likely to happen again this time. So let's go ahead and do that. All I'm doing is getting a list of previous earnings dates. So I had December 7th. I had, let's see, September 29th. May 25th. Hey, day after my birthday. Let's see, March 3rd. I'll do a couple in here. Nothing, I'm not going to go nuts. And 12/8. Okay. I just made myself a quick little list of earnings dates that happened in the past. So let's go back to the Analyze tab. Let's go back to Think Back. And let's go take a look at what happened around those dates. Okay, so the first one was December 7th. Okay, follow me on this one. Think through as if we had been in this exact same trade on December 7th, 2016. We would have had short options that expired that Friday because we were trying to trade the collapse in implied volatility. And we would have had long options that were, say, 3-4 weeks in the future. In this case, let's see, which ones are we using? We're using the 24th of March. And by the way, this is not set in stone. We might shift these a little. But we're using ones that are expiring about 3 or 4 weeks out. Okay, so that works. So going back to December 7th, if I look at the implied volatilities here, I was up around 38. And I go forward in time and boom. Short options are going right down towards zero. And by the way, you know the funny thing is in this calculation, these option implied volatilities don't even matter because we're so close to the expiration that they're basically either going to be in the money and worth something or out of the money and absolutely worthless. In our case, you know, we've only got half a day of life left in these. They're going to be eroding towards zero or whatever intrinsic value they have. Now, this is what I want you to be paying attention to, though. After the earnings announcement, we have implied volatility of about 16% on the options that expire in a week. We have implied volatility of just shy of 16% on the options that expire in 2 weeks. We have implied volatility of, hey, just shy of 16% in the options that expire in 3 weeks. Let's just say this is 15.5. And we have implied volatility of about 16 in the options that expire in about 4 weeks. So we have this tight little range of about 15.5 to 16% implied volatility. I'm just going to kind of wing it and say that I'm going to say my target is 15.75. All right, there's sample number one. Did everybody walk through? No problem, Bob. You can be our lookout on this. If you see anything that's absolutely crazy out there, that's really worth paying attention to and distracting from the class, yell. I'm kind of curious. All right. Other than that, I'm just going to plug forward with this thing. But you see, after the earnings announcement, this is the important thing. We had implied volatilities of around 20, these were 23. That was 17 days out. These were 27. All of these different implied volatilities, they all dropped to basically the same thing. They didn't have the earnings announcement driving their implied volatilities anymore. So they're all going down to roughly the same level. And in this case, that was on average about 15.75. All right, so that was going in and probably doing a little bit more of an analysis than we needed to on that. But I was hoping to show you how that all works. Let's jump back and do a couple more of these quicker. So September 29th. That means we would have been, whoops. I'm just going to take 3 weeks in the future and use that as my example. September 29th, dropping down to, hey, about 17%. Let's see. We'll say it's 17.5%. May 25th. All right, day after the earnings announcement, and let's use these two options. 16.5, 16.5, 16.5, 16.5. Okay, 16.5. Go back a few more months. February 3rd, or excuse me, March 3rd. Day after it, options that expired about 3 to 4 weeks. A little high, 17.5 here, 17.75. A little over 17, a little over 17. So let's just say 17, I don't know, 17.5. And we'll do one more. December 8th. All right, these are a little high, but remember this was also, no, actually this wasn't a rounded correction. Okay, we've got probably an average of 20 there, average of 20. A little higher, we'll just say an average of 20.5. You will get some outliers, but let me read through the numbers that we just grabbed as samples. 15.75, 17.5, 16.5, 17.5, and our outlier, which was 20.5. There's some pretty solid consistency there. There's really good, consistent trend of what's happening. They all fall into roughly the same level each time. In fact, the last 4 times, they have fallen into a range that's slightly less than 2 percentage points wide. That is wonderfully predictable. I love that. So what we have to do is take the evidence that we just got. Now, before I jump into that piece, does everybody follow what I just did? I'm putting myself in the place of the trade. I'm thinking if I had options that expired 3 or 4 weeks in the future, what would those things be worth at this point, volatility-wise? Well, we'll take a look at that in a second, Paul. Honestly, I don't care about what the market implied volatility is. I will adjust things slightly because of that, but this will come up with an answer in a few minutes that is either a good trade or a bad trade. And I'll show you how to decide that. And it doesn't matter what's going on around it. It will either be a good trade or a bad trade. It's one of the nice things about this trade. It's going to tell us what to do. Whether it's, sometimes we may have to make a judgment call when it's on an edge, but it's either going to be good for us or it's going to be bad. So you don't have to worry too much about what's going on around it. Now, I will say this, Paul. I have had earnings seasons which I went through and I just felt like I was beating my head against the wall because the answer kept coming up, bad trade, bad trade, bad trade, bad trade. And the reality is that, I don't know, maybe an election was messing things up, maybe something else was going on, but there was something that was skewing the volatilities in the market a little too much, and it was just making it so that the trade looked bad every time. You do want to take into account the current conditions. So when we're looking at these samples that I picked up, 15.75, 17.5, 16.5, 17.5, there's a lot more samples that are on the higher end of this than on the lower end of this. But considering that IV is pretty darn low right now, I might put my target fairly low. I might estimate, based on a little combination of evidence and honestly a bit of gut feel, that after this earnings announcement happens, the options that I'm going to be long on could drop down to about 16. It's the lower end of the average range. It's not the lowest, but it's the lower end. I think it's a reasonable guess. And that's what we have to do. We have to get as accurate as we can with as reasonable a guess about what we believe the IV is going to be as we possibly can. You don't want to go nuts on it and go super, super conservative because you'll never take a trade. You don't want to go crazy and be super optimistic that IV is going to stay super high because honestly it won't and you're going to get hurt. Figure out what you believe to be a decent, accurate estimate based on the market conditions right now. And I would rate now, say that about 16 is roughly where I would put my target. So let's work with that. Giles, could I use historic vol for the previous earnings date to make this computation? You mean historical volatility? That's totally independent of this. It really wouldn't have any bearing on this. We are using historical implied volatilities around the earnings date to tell us this. Yes, that's what we just did. Does that make sense, Giles? Or Giles? No. And Paul, did you have any other questions on that? Yeah, they're just different issues. As a matter of fact, what's interesting is that right now we're playing with volatilities that are probably the most divorced from reality that they ever get. The moment in time around an earnings announcement, the implied volatilities get twisted out of shape more than they are any other time when options are trading. And it's because you've got this moment that really is a make or break it moment for the stock. Can cause lots and lots of price movement. Let's go back to the trade and let's use what we now know to figure out whether this is a good trade or not. So the long options I really don't care about. Excuse me, the short options I really don't care about. These ones are going to be eroding almost to zero. So great. I don't have to worry about adjusting the implied volatilities here because in the afternoon before they expire, implied volatility is effectively irrelevant. These ones, though, are going to drop from 20.5% and 20.08% down to likely 16%. If I don't take this into account, I don't know how costly, how expensive my protective options are going to be. There's a chance that the protective options are going to be more expensive than I'm even capable of making from the trade, or there's a chance that the expense might be very small, leaving me with lots of room for the trade to make money. Easiest way to figure that out is this. If you're looking at the analysis tab on Thinkorswim, and by the way, Options House and TradeStation all have tools to do this exact same thing. I'd assume that most brokerage platforms do. In this case, I'm going to click on this gear. It's going to show me volatility adjust, and I want to get a little bit more specific, more parameters. And specifically, I want to adjust my long options, the 24th of March. So right now, let's just do some really quick math. I have 20.58 plus 20.08 divided by 2. All I'm doing is getting the average. The average implied volatility of those two options is 20.33. I'm subtracting 16%, which is my target implied volatility after this event happens. That means I have to adjust these by 4.33 IV points. All right, so more parameters, 24th of March, and I am going to subtract, what did I say, 4.33 minus 4.33. Now, before I press enter, fix this in your head. This looks like an amazing trade, by the way. I mean, we've got $1,600 worth of risk, and we could potentially be making $2,200, $2,300 overnight on a minor risk. Fact is, this is not reality. This, when I press enter, is a lot closer to reality. There we go. And actually, didn't end up being that horrible. So a few minutes ago, Paul, you were asking, how does this trade work if the market at IV is low? What would happen if you put a target implied volatility because you believe that the IV is going to drop to a lower level? This entire trade would be shifting down further. Or if implied volatility is really high on the long options and going to drop down quite a bit, it would shift down more and more. Let me show you if I put a drop of 6.33. Well, that drop in implied volatility costs us so much money that I wouldn't make any money in the middle of the trade. I'd have a very small area over which I could make money over here, and my break-even points would be super narrow. I would walk away from this trade. This trade that I'm looking at right here, not worth taking. Just not very good odds you're going to win. But that's not what we calculated. we calculated this is going to drop to roughly 16. I made my volatility adjust of 4.33. You'll notice that these two strikes right here are 16.25 and 15.75. We are centered right on 16. So on average, we're right about where we want to be on these. A couple of things to look at. Let's see, first of all, and we would scale this trade up or down depending on how many we want to take. But if this trade cost us about, let's see, $1,570 to take, and we left this all the way to the expiration at the end of the day, we would, and it stayed right in the middle, basically right where the current price of the stock is, we would be making $263 on 1570. Not outrageously good, but let's see, what is it, 253 on 1570. But it's a 16% return overnight. That's right, 16% overnight. If we had the stock move a little bit out and maybe land in a bit of a different area, we have the potential of making 1,200 here, 1,300, 1,400 here. All right. Let's just say we got absolutely perfect and made 1,400 over 1570, oops, which, by the way, won't happen. That's an 89% return. Let me show you a little bit more realistic way of doing this. And by the way, this P&L curve you're seeing right here is actually not what we're going to be dealing with all day. There's a few moments in time where this is going to shift a little bit. So if I was going to make a max of about 1,400 and kind of a minimum here of about 265-ish, I would just do 1,400 plus 265 divided by 2. About an average that I would get across that range is $832. Now, if I made somewhere close to $832 with my $1,570 trade, oops, hold on, divided by 1570, it's about a 53% return overnight. Will we necessarily hit 53%? Well, there's a possibility we could. Is it likely that we're going to hit perfectly there? I wouldn't go after that quite so aggressively, but in this case, based on the analysis that I just did, I would be very, very happy putting somewhere between about a 35 to 40% profit on this trade as a limit order and seeing if we get that when the market opens up in the morning. This trade right here actually doesn't look all that bad. This looks pretty decent. Now, we are analyzing this at night. You can't really know what's going to go on, but what we would do is use the same exact kind of steps, the same formula that I just did. Let me see, probably, hold on. We could do it tomorrow or we could do it the next day. Let me see, the announcement is happening after the market closes on Thursday night. So we could actually just go in and analyze this tomorrow and see if we came up with slightly different or better or worse numbers. Same thing, we know where the implied volatility is going and we want to look for a decent opportunity for a trade. We could analyze this all the way up to 4 o'clock in the afternoon on Thursday. As we get closer and closer to the earnings announcement itself, the implied volatility of the options that expire on Friday are going to be going up a bit more. So we're probably going to get a little bit more of a boost. The problem that we've got there is that as we get closer and closer to Friday, the theta erosion on those options are also going to kick in. So there's a little bit of a trade-off. Do you really get a solid advantage holding off till the absolute last minute? Most of the time, I don't do it way ahead of the earnings announcement, but I may not go all the way up to Thursday afternoon. It's just, I generally would do it a little bit earlier than that. in my mind, I would be looking at this probably on Wednesday afternoon potentially. Each time you look at the trade, you need to evaluate it based on its own merits at that moment in time. If you've got a situation where the bottom of this trade, and by the way, if I'm not making at least about a 10% profit at the bottom of this little saddle right here, I typically walk away from the trade. That's my normal cutoff. It's just too tight, may not work out so well. It's too hard for me to make money. So that would be cutoff number one, or reject test number one. If the bottom of this trade is making me less than 10%, I probably will walk away from the trade. This overall P&L will shift around a little bit as we approach the earnings announcement on Thursday night. I would reassess this tomorrow. Once again, targeting about 16% on my implied volatility, and determine, is the trade I can take at that moment in time a good trade? Now, there's a couple of other tests that I would really encourage you to do before you say, yes, I'm happy with this trade. So let's kind of walk through those, and let me explain how I would look at these things. So anybody have any questions at this point? Lou, but am I actually holding the short options through expiration? No, absolutely not. We are done 100% out of this trade all the way by tomorrow afternoon. But here's the thing: we don't have to hold these till we don't have to hold them till expiration. Even if we spend a few cents to close it, that's typically being compensated by the long options that we're selling at the same time. We're really not that much better off or worse. If we wait till the end of the day, we get a little extra theta erosion in the long options, which means we lose some money versus the money we saved from letting the short options expire. Before the end of the day, we are completely 100% closed on this trade. Now, if the earnings announcement happened to be on a Tuesday or maybe a Wednesday, you do have the choice, and the dynamic is slightly different. You do have the choice of potentially holding on until Friday, and that can get you a little bit of an extra profit built into the trade. But it costs you. I mean, you're basically dealing with the risk that the trade could go bad on you over that time. The majority of the time on this trade, I'm exiting the morning after the earnings announcement. I'm putting it on a day, either the afternoon before the earnings announcement or 2 days before the earnings announcement, and I am completely out of the trade by 9:45 in the morning, maybe 10 o'clock. My personal favorite way of getting out of this trade is put a limit order on it. Let's not be overly greedy. Let's just say that I'd be exceptionally happy with making a 35% return overnight, between 4 o'clock and 9:30 the next morning. Figure out what that limit order price is, put an order to close the entire trade at that limit order price, and as the market opens up and does whatever craziness it's going to do, if at some moment in time you can get that order filled, it closes your trade and you walk away with 35% return. Maybe I get a little bit more aggressive, go to 40, maybe 45. I probably wouldn't go too much past that in this case. Sometimes when I run that average, I might have 75, 80% return on that. In that case, I might be more aggressive. I might be going for a 60% return. Sometimes it might be a little lower. I might be looking at a 40% return on average across this area. Well, in that case, I'd probably go for a 25% return. I want something that can get me out nice and clean and easy. There are risks in this trade, and we will deal with those in a second. But if we can get out nice and clean, we basically made a good solid chunk of money overnight in a situation that gives us a lot of advantages. You're going to lose some of them. You're going to win some of them. On average, tend to win more of these than I lose, and the losers tend to be fairly manageable. We'll dive into that in just a second. But we need to go through a couple more things. Now let's see. Okay, I really, Dino, I really don't want to use these sessions to review trades from the ALTB. or any of those things. It just gets us way off. If we have some extra time at the end, I might be able to do that, but that's really not what these sessions are for. So try to avoid that. We'll have enter and exit targets, absolutely, Paul. We're going to do a plan on this, just like we do on the other trades. We're going to have a clear understanding of what could go wrong. We're going to have an understanding of what can go right. We're going to lay everything out, and we're going to say, you know, this is my plan for exiting. I'm going to have a limit order that does this. If that limit order doesn't get hit, these are the things that I'm going to assess as far as the risks and make my decision to maybe take a smaller profit, or potentially I'm in a loss situation. What am I going to do then? So we'll have a nice, neat, broken down plan of how this all works. Excuse me, Lou. I'm sorry if I made that confusing. I would be closing this the morning after the earnings announcement. Let me be very, very clear about this. When I'm talking about exiting this trade, in this case, Costco is doing its earnings announcement on Thursday night. I would be exiting on Friday morning after the earnings announcement. We are making our money because that exaggerated implied volatility collapses after the earnings announcement, and that's how it's giving us an advantage in the trade. So yeah, you're right. I misstated that. Sometimes when I stumble along on these things, my mouth moves faster than my brain. So the idea is, let's put together a plan. I will stick out a little side note on here. If I were to take this tomorrow, which means that I'd be holding it all the way through Wednesday and all the way through the daytime of Thursday, if I ever saw a 15 to 20% profit in this trade before the earnings announcement ever happened, I'd just take it. You sometimes get that. Every once in a while, it just works out in your favor where before the event even happens, you can take a 15 to 20% profit. Heck yeah. I will walk with that any day of the week. 15% for no risk. Sign me up. So let's look at the trade itself. Dig into some of the other things that would make me nervous about this trade and make me say I really don't want to take it. And then let's look at how the trade would work while we're managing it or exiting it, and try to make some plans about what we would do. Everybody good so far? Is there a difference in the options behavior between earnings announcement pre-market or aftermarket? Gina, no, there is no options activity pre-market or aftermarket. We're just seeing what Costco looked like at 4 o'clock today. Options don't trade pre and post, so it's irrelevant here. We can't trade the options. So to be honest, this trade that you're seeing right here is just what we would have gotten if we had been filled fairly close to 4 o'clock this afternoon. We'd still need to reevaluate the exact same trade, go through the same process during the live market, and then make the same decisions that I'm trying to work through right now. So let's go through some of those decisions. First of all, did we get at least about 10% return in the middle of this trade? Well, in this trade, Costco, the answer is yes. If we are moderately accurate about our estimated implied volatility target on the long options, we would be looking at roughly about a 16% return in the middle of this trade after the earnings announcement happened if the stock just doesn't move anywhere. Now, there's a chance IV might drop a bit more, and sometimes if the stock is just dead flat and literally does nothing, it sometimes does. The reason for this 10% here is not so much to make a big profit. It's to protect me if it doesn't do anything and IV drops a little more. I might even take a bit of a loss in here, but I don't want to take much. As long as I have about 10% in this area, I should be fairly safe. Number 2, this trade is going to work over a certain range. In this case, my break-even points are 169.74 and 185.66. So let's just take a little note on that. 169.74 and 185.66. Okay. Based on this analysis, as long as I land between those two numbers, I should make break even or better. I should be in pretty decent shape. Now, question I have in my head is that, is it likely I'm going to land between 169.74 and 185.66? Well, right off the top here, we've got about a $15 range on a 100, what is it, $177 stock. So the range over which we can, be successful is about 10% overall of the price of the stock, a little less than that. Let's actually match this up with the stock's previous movements and see if there's anything that this basically says, this is crazy, I don't want to do it. So remember, we're only holding on to this trade for a pretty short period of time, very, very brief moment, just a couple of days at best. Hold on. Price level. So 185.66. You don't have to be perfect about these. What I'm trying to do is get a little bit of a sense of what has happened over past earnings announcement, and is it realistic that we're going to stay roughly within this range for this earnings announcement. This is the part of the trade that I'd call a sniff test. I'm just scratching at the trade a little bit and asking myself, is it likely this is going to be a decent trade? Is there anything about this that just doesn't smell right? Sometimes you'll find that. Sometimes you'll find ranges that are just too darn tight and they're not worth taking. You're just not comfortable about them. I'll caution you about this, though. Don't try to make this a perfect trade. The real advantage here is not trying to win every single one of these and never taking a trade that you don't, that you think you've got any level of risk in. The advantage is taking a good, consistent amount of these and, on average, making far more than you lose. And that means that you've got to accept the fact that some of these are going to lose. You don't want to be perfect, because then you'll just never take trades. By the way, there's just no way to be perfect, period. So it's a pointless effort. What we can do is be prudent. So here was this earnings announcement. It closed at 153.85. Next day it opened at 156.64. So basically $3. And over the day it maybe moved up and down a bit more. If we had closed 177.18, went up $3, that's only up to about 180. Even with a little extra movement, that's plenty of room. Even if we go down, we're still within our break-even range. All right, so there's one test. This one, no problem at all. This one, a little bit more maybe. Close 144.54, open at 149, so about $5. Still well within the range that we're dealing with here. I would just go back in time and just poke around a little bit. How often does Costco have an outrageous gap around their earnings? Now, Costco's had some big movements, but they weren't around earnings. There's a couple of gaps here and there. Overall, their earnings announcements aren't particularly spectacular affairs. Great. I like that. Perfect. Means that we've got a pretty decent chance of being within this range. All right. Check. There's one of our check marks right there. We made 10% in the middle. We're moderately comfortable with the range. Now, let me give you the counterexample. If I had gone back and seen that Costco did massive gaps, $10, $15 up, $10, $15 down, $20 up, $20 down on a regular basis, maybe half the time it did gaps that are significantly outside of this, I'd walk away from the trade. This isn't worth it. It's not being prudent. It's not being smart. Walk away. Don't take the risk. There's plenty of these out there. Not right now, but there will be in a few weeks. But it passed the test, so we're looking good. Now, we just basically have to figure out how are we going to manage this. Are we comfortable with the trade? Do we think that there's anything about this moment in time, this earnings announcement, that's radically more risky, that's crazy, that means that we shouldn't take this? Is there something different going on? Well, maybe State of the Union address might be something that riles things up. I don't know. Tomorrow we'll evaluate that. But let's just see. Remember, we're not in the trade for very long. We're not exposed to a bunch of big time, risk over time. So we really just want to make sure that what we think is going to happen has a pretty good chance of happening. Let's see. Gina, question relates to the strategy. We know the some stocks like Costco in this example, announces after market and the market has overnight to digest the earnings before the trading starts. While the trade announcement pre-market needs no time for digestion, therefore the market starts trading and potentially more volatility at the start. Yeah, that's actually a really good observation, Gina. What generally tends to happen in those cases is the stocks that have a earnings announcement just prior to the open of the market, and you're right, it's actually a pretty important point. The market doesn't have as much time to react and absorb, digest is a great word for it, the information. But what's interesting about it is that the market makers also know that, and the people in the market also know that, and it generally means that the people selling options use that as an opportunity to add in an even extra higher level of implied volatility to protect themselves against that higher level of chaos you might see at the open of the market. It really comes down to the same thing that we've been looking at on all of these trades. Do we have a profile in the trade that makes sense? And in a lot of cases, you'll find that the ones that have pre-market earnings announcements actually have better profiles and are paying you better to take what honestly is a little bit more of a risk. There's a real risk there. It's not outrageous, but if I compared to a stock that announced post-market and a stock that announced pre-market, the pre-market one represents a little bit more movement risk during the day. So generally, you expect to be paid slightly better for that. That's what you're going to look for. Smart question though. I'm glad you said that. That's you're looking at things well. That's really good. Gina, did that answer your question? Because I was quite confused about the pre and post market. I think I misunderstood what you asked originally, but that answered your question correctly? Okay. Might seasonality affect this? No, not at all. I mean, to a certain extent, maybe some things might be there. Annual earnings announcements tend to be a larger data dump than quarterly earnings announcements. You might see a slight effect or a slight difference during that. But in general, seasonality effects tend to be very, very, feather light effects that kind of give things a little bit of a push in a certain direction. This is the equivalent of killing a fly with a sledgehammer. There's not much that affects this. It's, you can jump out in front of that 18-wheeler if you want, but you're not slowing it down. It's this is probably one of the biggest price effects that you're going to get in the market 4 times a year. But yeah, there are some considerations. You might want to consider an earnings announcement for an annual event, an annual earnings, a little bit more potentially volatile, but at the same time, you generally get paid a bit better for them. So there's a bit of a trade-off there. Not always. You need to make a judgment call there. I don't really see a whole lot of difference, to be honest with you. I've just not picked up on much difference. Now, let's talk about managing the different ways we can manage the exits. And yeah, Gina, there's a good question there. Is there any preference to entering the trade tomorrow or Thursday? Honestly, Tony asks, is there any preference to entering the trade tomorrow or Thursday? Before we get into managing it, let me explain what is going to go on. Now, implied volatility is going to go up between now and Thursday evening. So this implied volatility of 41.77, or let's see what it actually is in the market. At the money, it's closer to about 35. That implied volatility, 35 to 40, let's just say 37.5. That implied volatility is going to increase between today or right now and Thursday evening when you're right in front of the earnings announcement. Now, this is where things get a little bit questionable. That does not mean that you're going to receive more of a credit. Because remember, let me see, what strikes did we use? 172.50. There's a theta erosion between 4 o'clock yesterday and 4 o'clock tomorrow. This 172.50 put is going to lose 27.9 cents. And this 182.50 call is going to lose 24.9. So let's say 25 cents on one side, and let's just round it off 25 cents on each side and call it 50 cents. We're going to lose 50 cents worth of value from theta erosion, actually a little more than that, between close of the business today and close of business tomorrow. So that would put us at Wednesday evening. We're going to lose another 50 cents of theta erosion or more, probably closer to 60 cents at that point, in theta erosion between Wednesday and Thursday night. Now, that does not mean that we would get a credit that is $1.10 less, because at the same time that theta erosion is eroding the price down, volatility, which is simultaneously going up, is going to be increasing the price of the options. Now, here's your question. Here's the real question. Does volatility go up fast enough and add value to those options fast enough to overcome the theta erosion? Because if we're getting $2 in credit right now, a couple days away, how much credit are we going to receive in the trade the day before? Now remember, this is Thursday afternoon and it expires Friday. So we may not actually receive as much credit because we've got a lot of theta erosion that's pushed the value of the options down while simultaneously increasing implied volatility is trying to push it up. Which one of those two wins? Which one's the greater effect? I haven't seen a really clear answer on that. Sometimes the implied volatility moves into the whole thing really early, and then the theta erosion is a horrible effect near the end, and it hurts you. You would have been better off getting in earlier in the week. And sometimes you would have been better off getting in right, 3:45 that afternoon before the earnings announcement. There's one advantage that I do see to getting in early. Number one, if you always have to make sure that the trade makes sense. That's your number one thing. Look for those features that I talked about and make sure that the trade makes sense. But number two, if you can get in early and the trade absolutely does make sense, there's a possibility that you could walk away with a, as I said, 15% profit before the earnings announcement ever even happens. Heck yeah, take it. I mean, as a matter of fact, I would, if I got into this trade on, say, Tuesday or maybe early Wednesday, I would put a limit order to make a 15% return on the trade and just leave it there until 3:55 on Thursday evening. And then I'd cancel it. If it fills, beautiful, walked away. If it doesn't fill, I've got the trade I wanted. It's a win-win situation. That gives you a little bit of an extra opportunity. Do I do that a ton? Some, not a huge amount. It really just depends on the situation. I will have a greater tendency to do an early entry into the trade if the trade has an earnings announcement on a Thursday, or worse yet, a Friday morning. I would probably have a lower probability of doing that if I had a trade that had an earnings announcement on, say, Tuesday morning, Tuesday night, maybe even Wednesday, because I'm not dealing with that same theta erosion. Does that make sense? Does that, so Tony, you asked the question, does that help you understand kind of the dynamic around that decision? Anybody else have any questions around that? Okay. Let's jump over the trade and let's figure out how we're going to manage this. Now, what I'm going to walk you through is a combination of rules of thumb that I've kind of developed over the years and just kind of using a little bit of logic around this. I want to show you something, but it's really hard to show you clearly. You see this kind of dual peak, dual calendar formation that we have here? This formation doesn't actually exist in exactly this form until the very last minute before the options expire. Prior to that, you have a curve that looks a little bit different. And you see now this is where it's really difficult for me to show this off. This purple line right here, the intermediate P&L, ignore how low it is because that's not really the way it's going to work. But take the shape and move it up. In fact, move it up to the point where this middle part right here is actually above the P&L down here on the bottom. So let's say it's maybe up in this area. Keep the general shape and realize that the P&L here would not be at this peak at 10 o'clock in the morning. It would actually be down here. So theta erosion would actually be driving the profits of this up very, very fast during the day if you happen to be right in this area or right in this area. So that the area surrounding the strike, theta erosion is going to increase your profitability on the trade during the day. It's going to happen quite rapidly. It's going to be quite good. Problem is that to get it, to take advantage of that, you have to leave your trade in, and you're exposed potentially to the risk of the stock moving further up or further down and potentially going into a zone where you're losing money. There's a trade-off there. Do you want to go for extra profits, and are you willing to take the risk if you do that? If you happen to have the trade land right here in the middle, once again, just envision this purple line a little higher. If you happen to have the stock land in near the middle of this area, then you are in exactly the opposite situation. It's just the dynamics of the trade, but the P&L will be hurt by theta erosion. So the longer you wait until later in the day, the greater the likelihood that the price will erode down and cause you to lose, well, not necessarily lose, but erode the profit you have to a smaller amount. Have the profit drop down, down, down until its final resting place at the expiration. If you're in the middle, you want to close the trade out relatively early in the morning. It would, you know, I would probably be dealing with this and say that I'd really like to be out by, say, 10:15. You've got about 45 minutes to close it down. It's not the end of the world. You're not killing yourself if you don't do that. But the longer you leave the trade in while the stock price is sitting in this middle area, the more effect theta erosion is going to have against you, and it's going to hurt you overall in the trade. You want to avoid that. You want to keep as much profit in your pocket as possible. So starting to build out a general set of guidelines or a set of choices that I can make on this. There's another situation. If the stock were to gap out fairly far, these peaks are where our strikes are. Now, don't panic if the stock jumps out past your strikes. That's not your break-even point. It's not the end of the world. But we are in a little bit of a different risk regime. The problem with out here is that if the stock continues to go, we are now sliding down the curve into the point where we're going to take a loss. I'm not a big fan of that. You know, and especially if you've had something gap out fairly far, you might see this thing continue to run for a bit, and you might be chasing it and losing a bunch of money. So, as a general rule of thumb, I take about where the peak is and about where my break-even point is, and I split the difference. And I do that on both sides. And just because my brain likes symmetry, and don't ask me why, it's just how it's wired, I look for the break-even point here, and I basically try to level it off with the break-even point, or with a crossing point for this. So just get those about the same level. And there's my nice, elegant trade. Did I need to do it exactly that way? No. what I'm trying to do is basically set up some generalized rules of thumb that allow me to make some decent decisions about my trade, and sometimes in a fairly fast-moving situation. So let me walk through what you have for possibilities here. If I were to read this, I would say that my rules for the trade are: if the stock gaps down below 171.35 and doesn't immediately go back up into the middle, I'm not saying it has to trigger something, but if it gaps down here and it's below this, I would close the trade out first thing in the morning. That's because after the earnings announcement happens. That's because I'm worried about the risk that the stock might continue down. Same thing on the upside. If it jumps up above 183.95 and it looks like it's solidly there, I would close it out because I'd be worried about the risk of it running up. In both cases, that does not mean you'd be necessarily taking a loss. You have very little control over where the stock opens up. There is a chance, and I've dealt with this a handful of times, that it might gap way, way out. I once dealt with almost a 2.5, 3 standard deviation gap on a Google announcement once. I took a 50% loss on that. I thought that was pretty reasonable considering the amount of gap that it did. You might have it open up here, and at that point, you just close the trade and you walk away. So, rule number one: if it gaps above 183.95, gaps below 171.35, I would close the trade. Set of rules number two: if it lands between 171.35 and 174.16, roughly, I could choose at that moment in time to close the trade out, or if the stock seems stable in this region, I could leave it on until later in the day and go for a greater profit. I'm not saying that I have something that I absolutely have to do. What I'm saying is that I have an opportunity to make a choice. Get aggressive, go for the profit, close out now, take the profit I've got in hand. You'll probably actually be in a pretty decent profit if you happen to be in one of these areas. You're going to be looking at potentially hitting your profit target right off the bat there. That applies to both of these areas around the strike. Center. Well, the center is also another choice. If I'm between 174.16 and 180.49, especially if I'm near the middle of this, my choice is to close the trade out first thing in the morning. Now, you'll notice that almost all of these, except for a very, very minor situation where I might be shooting for some extra profit, has me closing the trade out first thing in the morning. You can follow these rules and you can follow these guidelines, and they're good. They're usable, they're understandable, they're an effective way of trading this situation. But I've actually gotten lazy over the years. I find I get lazier and lazier as I get older, and I just simplify it. One of the things that I do is I will kind of do a general rough estimate of where I could land as far as profits. 50%, 55% wouldn't be too surprising here. I trim that down to a reasonable amount, maybe 35%. I put a limit order out. So if I get filled in this at $1.57, well, what I would do is this: $1.57. I'd probably stick in 8 cents just to cover my commissions. So that's $1.65 in cost. Let's say I felt like I had a reasonable chance of going and getting a 35% profit. So times 1.35. All right, $2.22. I would put in a good to cancel limit order the night before the earnings announcement. Good to cancel means it's going to exist right there in the morning when the market opens up, and I would leave it there. Now, there's these sayings, that the first half an hour of the market is amateur hour, that, you really shouldn't trade things till things settle down. There's a lot of good thought behind that, and there's a lot of good reasons. But don't take it for gospel as that's the only thing you should do. We would actually be using that. Amateur hour can be either to your advantage or hurt you. There's a lot of chaos. The market's forming. The strike prices are jumping around. People are anxious to dump their shares, to buy their shares, whatever. If you leave an order out there that you are very happy with getting filled and you are going to make a good, solid profit, and the market comes up and hits it, absolutely beautiful. No effort, no sweat, no muss, no fuss. Great. If it doesn't, you have a set of rules to follow, and you manage the trade. You cancel your limit order, and you take a little bit less of a profit, or maybe take a bit of a loss. The idea is you want to maximize your opportunity for getting out at a good profit. I think that the limit order target is a great way of doing it. It doesn't get you out every time, but it gives you a chance to get some very, very good profits that honestly might have been fleeting profits. It might have gone by very quickly. But since your order was sitting there in the market waiting for it anyhow, you got hit. If you don't get hit at that profit margin, you're going to fall back to your plan to manage it. Most of the time, I would say the longer I do this trade, the less often I keep it on until later in the day. More often than not, I'm just shutting it down. It's taking my decent profit and walk. If it's way outside, that means I've got a rule that tells me that I'm shutting it down. There is no real stop loss on this. You're just shutting it down as quickly as you can to minimize your loss. Reality of this, let's talk about failures. How can this thing go bad, and what would happen to the trade if it did go bad? All right, biggest number one risk is the stock gaps too much. It goes way up or it goes way down. I don't know what it is, some surprise in the information, the earnings announcement, something causes it to gap. Now, what's interesting is that in those cases, in general, I'm not saying this is perfect, but in general, we would not be dropping to quite as low of an implied volatility. A surprise that large generally means that the options are going to have, the longer term long options are going to have at least slightly higher implied volatility in the trade. And that's actually a big advantage. So our initial target was 16%. But if something happened so outrageous that it gapped way up or way down, we wouldn't drop all the way to 16. We'd probably drop, but we wouldn't drop all the way. So let's adjust this and see what that means for us. Now, I'm not going to be crazy here. I'm going to just say that instead of dropping 4.33, we drop 3%. That just means that we're 1.33% better than what we expected, which isn't crazy. It's just a small amount. But that right there moved the profitability of the trade across the board up quite a bit. But the biggest thing that it did, now remember, this is because we gapped out quite a bit. It moved our break-even points out. And it made it so that if we were gapped out here, we were likely to take less of a loss. Now, that doesn't mean that if this thing drops down to 115, we're not taking a fairly substantial loss. There's nothing we're going to do to stop that from happening. But in most cases, the way that implied volatility works, it actually reduces the loss in the trade if something really crazy happens. So this is a style of a trade that I'd say fails gracefully. It can fail, and it will fail. You will absolutely have losers in this trade. But in general, I find that majority of the time, I can manage the trade to have a loss of less than 40%. My worst trade that I had in one of these situations was Google that did nearly a 3 standard deviation gap, and I ended up taking a 50% loss, which surprised me because the amount of distance that Google gapped, I thought I was going to get killed. It didn't take as much as I thought. So, don't think you're safe, but it does work in your favor if things gap. Flip side of that is the opposite, which is the boring announcement. And this is probably a smaller loss, but this one really sucks. I just don't like these. What happens this time is absolutely nothing. We go into the earnings announcement at 177, and we wake up in the morning and everybody said, wow, that was the most boring thing I have ever seen. The stock doesn't even move. It's 177.05, and implied volatility drops more than expected. Now, it's not going to be outrageous, but it will drop more. Here we are sitting in the middle of the trade, and suddenly we are at a small loss. Now, the nice thing is, if the stock were to move up or down, we could go back into a winning situation, but the reality is it's probably not. It's just not going to do a heck of a lot. And we are going to take a small loss. Now, this is $152 loss. It's about a 10% loss. It's reasonable. It's a risk well worth taking. It's not going to happen that often, but understand that you will have moments when it could happen. This is the main reason why I want to have at least 10% where I believe, in the middle of the trade, where I believe that the drop in implied volatility will be 2x. It's to protect me from making this into a 30% loss instead of a 7, 8, 9, 10% loss. Usually these are pretty minimal losses, but they're annoying. I think that they're more frustrating than anything. So put this back at negative 4.3. There we go. Now, those are the situations you are likely to see. Let's see. Gina, does it make sense to do the opposite of this trade 2 to 3 weeks before the earnings announcement? Okay, the opposite of this trade, no, but yes, there is a totally different trade that we would be doing at that point. As a matter of fact, I just wanted to finish up this, and we'll jump over to that, because there's a lot of trades you can do around this. So does everybody understand, before we go into a different style of trade, does everybody understand what we've got for trade here? And what's driving the trade? Why is this trade getting created? How is this trade basically there? And why do we want to take it? Now, we're using that fear, uncertainty, and doubt right before the earnings announcement to give us this extra advantage. In fact, we're basically using that to give us this extra width of the trade and this extra bonus little P&L in the middle of the trade. It's that inflated IV beyond what the real risk is. That's what's creating the opportunity. That will not be there every single time. I will regularly throw out these trades if I don't see enough P&L in them. If this middle isn't at least 10% up, I'd chuck it. You're just not going to get a good trade. But during earnings season, there's a lot of these that pop up, and you'll have an opportunity to look at these a lot. You'll find a fair number of these. With the disclaimer that every once in a while we have a weird earnings season. We just came out of one. It's always frustrating. I get excited going into earnings season. It's got a lot of opportunities. And suddenly you're into trade number 4 or 5 and you're just beating your head against these things. And you have to start readjusting your target implied volatilities down further because IB drops more than expected or something's happening. And you just can't make a go of it. Be patient. We're here to trade for years and years. I'm 20 years in on this game. And one quarter is not going to make or break me. Just, realize that this trade's been here for a long time and it will be here for a long time into the future. Don't have to make it every single time. Let me see. Tony, the question is, are you able to close out the trade on all 4 options at the same time, or do you have to split them up in some way? I close them out with all 4 options. I've had people go back and forth and argue about splitting them into different put calendar versus call calendar, covering your short strangle first and then closing the long strangle. Honestly, I just put it out as one order and I get a fill. Most of the symbols that we're going to be working with are higher volume, more active symbols that have a lot of activity, and especially the morning after an earnings announcement, there is a ton of options activity. It's, in general, not difficult to get filled on the exit on these. Sometimes it's a little challenging to get filled on the entry. I wouldn't go doing these trades on something that isn't a higher volume, actively options traded stock anyhow. I mean, you're not going to want to go down to symbol number 499 in the S&P 500. You're going to want to focus on your top 100 to 200 symbols. And even out of that, there may be about 70 or 80 that might be decent possible trades. And then after you filter out the good trades from the bad, you might only walk away with 20 during an earnings season. But there's still quite a few of them out there. I mean, 20 trades over an earnings season of this type is pretty active work. And you've got an opportunity for some good money there. Yeah, Paul, there is a risk breaking the legs up. And let's walk through this. And there are different approaches to this. I have never found that much of an advantage. I know people say leg in and all these things, but I've never found that much of an advantage to legging in. But there's definitely a risk of a major disadvantage legging out. So right now we have a trade that consists of basically a call calendar, which is the short and long call over here, and we have a put calendar, short and long put over here. If we took these and broke these up, I mean, we could enter them one way and break them up and exit a different way. If we broke those up into those two different calendars and tried to exit at some point in time, well, at any one moment, as the stock is moving back and forth and waffling around and going one direction and the next direction, you've got one of those trades, one of those two, which if you put a bid-ask midpoint limit order out on, is going to get filled very, very quickly. And at the same exact time, the other trade is going to be losing money. So if you have a sudden surge in one direction, you end up closing out one side of your trade, and the other side of the trade is sitting there losing money fairly rapidly. Now remember, these two trades were designed to work in tandem. The put calendar spread and the call calendar spread are supposed to work in tandem, and as one loses, the other's winning, therefore you're balancing them out. If one of the two gets filled fast and leaves the other one, you now suddenly have a trade that is capable of losing money or gaining money much faster, and it can go against you very, very quickly. If you're lucky, you might get a better fill on both of them, if you're lucky. If you're not lucky, you will get an average fill on one and then have the other one have slippage against you so bad that you wipe out the profit for your entire trade. I don't see that as a particularly good approach. If you're trading good volume, high focus symbols, you shouldn't even ever have to do that. I just don't. And I've never had a real problem getting out. Now, there's another way of getting out, and it's not treating these as calendars. Another way to look at this is I've got a short strangle and I've got a long strangle. Now, ideally, I would love to have a situation where I could let the short strangle expire at 4 o'clock the afternoon of the option, expire at 4 o'clock the afternoon after everything's done and not have any costs. The problem is that if I did that, I'm leaving my long strangle over the weekend. Now, one of the problems that we have with that is that the trade is designed so that the short balances off the theta erosion of the long. And overall, the theta erosion is not a big deal when you've got the full thing together. But if you leave just the long options over a long weekend, or over a weekend, coming closer and closer to their expiration, you're going to have a bunch of theta erosion that you're going to have to overcome by price movement, either up or down, to make that long option worth enough, at the end of the weekend to leave it on. It's a lot of risk. You are likely to lose quite a bit of money on that trade by doing that. And so I don't encourage people to leave any part of this trade on after the first option expires. It becomes a totally different trade with totally different features. The second part of that is that usually over the next 2 days or so after the earnings announcement, all of the options are settling down in implied volatility a little. So IV's dropping. That's a second thing that will hurt a long strangle. So that's not a really good plan. I could, if I felt like, take my short strangle, which would be my short put, my short call, buy to cover first thing in the morning, and then try to find a spot sometime during the day where I can make a little bit of money with my long strangle, or make a little extra money with my long strangle. That could work. You have to close your short strangle first. You cannot close the long strangle first because you immediately change your margin requirements to the margin requirements of a short naked strangle. And your broker will call you up and they will be quite upset with you and they're going to insist that you send them some money. Very, very much want to avoid that. So you could close the short strangle first and leave the long and then go for a higher payout on the long strangle. Once again, it's a risk. You've got potentially theta erosion and maybe dropping IV going against you for the potential of maybe making a little extra money if things went further out, up or down. I don't play the game that, like that. You're not playing to your advantages at that point. You're not playing to your edge. What you're doing is you're gambling. If you're really good at that, great. Go for it. Make some extra money. I'm not that guy. I'd rather just close the whole thing. So there we have the full front-to-back analysis of all the different ways you could possibly exit the trade. Paul, is that basically what you've seen before in these trades? Is that what you've experienced? Because you said you lost money breaking up legs. Does what I just described match up with your experience there? Oh, ouch. Yeah, so you made the mistake of selling your longs first? Oh, man, I'm sorry. That is not a pleasant call. That is not a pleasant call at all. And I'm curious, Paul. Using you as a live example here. What was the experience with the discussion with your broker? I'm guessing that it wasn't fun. Does anybody have any other thoughts, questions? Not happy. Gave you 2 days to pay up. You're lucky. Depending on the brokerage you were dealing with, certain brokerages out in Long Island and over in New Jersey that I used to deal with, it would have been 2 days to pay up, or a guy would have visited you with a club that looked a lot like what they kill fish with. Yeah, avoid that, please. Understand that naked short strangle, if you leave that even for a brief moment, don't make that mistake. Most brokerage platforms these days will stop you before you do that, but just be careful. That's another good reason to just avoid breaking it up. Just do it all at once. All right. Questions, thoughts? Does everybody have a decent feel for this? At least understand how this all fits together, what we're doing, why it works, why we might consider closing it, taking a profit, how we're going to handle risks. Hit me with any questions you have. Flip side of that, just look interesting. Now that you know what you're looking at here, do you think that you could use a trade like this to create profits? What's the price level in and out? I'm not sure I understand exactly what your question is, but it depends on what the exact setup is. In this case, this trade is $1.57 debit to exit, and I'd be looking for a profit target of probably about $2.22 credit, $1.57 to enter, and I'd be shooting for a profit target of about $2.22 to exit. But this will shift depending on what day I get into the trade, even sometimes the time of the day. It can be fairly dynamic. What you want to do is you want to make sure the form that you're seeing right here is working and the criteria are solid. Making 10% or more in the middle, and I do a sniff test to make sure that I'm comfortable with the break-even points. Make sure that there's nothing too crazy going on, and this is not some kind of outrageous situation that I need to be scared of. Sell stop? I'm not sure I understand what you're talking about, Paul. What would the sell stop be? To exit this, I'm literally just putting a limit order out, a good to cancel limit order, so that it doesn't just cancel on me at the 4 o'clock, but good to cancel limit order that is going to be live the next day to sell the trade at $2.22. And as the price goes up, because the change, by the way, what's happening is the drop in value of the short options is going to create a profit difference between the short and the long options. It's greater and greater, creating a higher and higher price, higher value that I can get out at until I hit the $2.22, at which point somebody would take my $2.22 limit order off the table and I'd walk away with a profit. Now, simultaneously, the long options are losing a little bit of money, but not nearly as much as the short options. The short options are collapsing to zero very quickly. Paul, if the price goes below 157, do we quit at 80 cents? Actually, you don't need that. Normally, I would put a eject point or something along those lines into my trade plan. But I could do that if you wanted. But honestly, it doesn't matter because the other rules that we put into place would have gotten you out anyhow. If I put in a 40% stop loss on this, a 40% eject point. Now, let's look at the reality of that. Number one, a true stop loss isn't going to do me a darn bit of good because if this thing gaps way up or way down, I'm going to get filled at whatever happens to be the price out there at the open anyhow. It's not going to limit my risk. It's not going to do anything to control anything. Number two, if that situation happens, I already have a rule in place that says get the heck out. Now, there is no question of what is my stop loss. I've already violated one of my rules, which is if I drop below 171.35 or if I jump up above 183.95, I'm out. So that gets me out. Third possibility, nothing happens and implied volatility drops further than expected. Well, if that happens, it's unlikely I ever would have hit my stop loss because that's not going to create a 40% loss. And I have a rule that says get the heck out. So this is one of the few cases where a stop loss, a eject plan, doesn't really make any sense. All of the situations you would have enacted one of the different plans anyhow well before you got to the eject. So no, we don't need that in this situation. If you want, you're welcome to it, but I think you're just going to be paying attention to two rules at the same time. So does that make sense? Yeah, Tony had a good point. He said, warn everybody that the numbers could change tomorrow and not just use the values shown tonight. Absolutely. That is an extremely good point. I've kind of alluded to this before. This is a dynamic trade. The $1.57 debit that you're seeing right there is not necessarily the exact right price that you want. We could have a trade that has the value of the long options shift a little bit, the value of the short options shift a little bit, and we could end up with a good profile that looks very similar to this and have a price that's actually totally different from this. It's the profile of the trade that matters. You need to take a look at the trade itself and evaluate it at the point you're taking the trade. Now, I could, let's say we woke up tomorrow and this trade is about where we're looking at right now. I could put an order out and say that, as long as we don't get filled at higher than, say, 165, I'm happy. But I don't want to do that because tomorrow morning you do need to evaluate the trade as it is at that time. It's the profile that you're looking for. As long as you're comfortable with the profile, the trade is good. The debit does not necessarily matter that much, and that can change quite a bit. Plus, if the stock goes up or down, I'm going to reevaluate my strike prices. I'm going to do the same process again, and I'm going to choose different strike prices. So it is important that every time you're looking at one of these trades, you're looking at it from the point of view of right now. Is it the right trade for this moment? What are the questions? We're getting some good questions here. You guys are thinking about this, which is what I really like. Let me see. Any more? Any other thoughts, ideas? Let me flip this around and just do a quick poll, and I would like to get people to answer. It gives me some feedback on what's going on. Does the trade make sense in your head? Do you understand basically what's going on? We're going to have lots of opportunities to practice this in the future, so you don't need 100% perfect knowledge, but you feel comfortable enough to be able to, that you understand what's happening. Yes, yes, and yes. Good. Everybody? Would like to get some feedback here. We've got some good answers so far. Halt to organizer. Everybody good? All right. Yeah, and Gina, that's perfectly acceptable. Gina's answer is understand the concept, need practice. That is where I want people to be right now. Now, if I can get you further, that's great. If I can teach you every little detail, in these sessions, then that's wonderful. But reality is probably aren't going to get you, you're not going to be a 15-year veteran in a 3-hour session. But if I can get you to the point where you understand this and all we're doing is refining what you know and working on it and building your skills and getting you a little bit better each time, that's great. That's right where I want you to be. So Gina, you're there. Okay. Let's flip this around. Gina had a good question before. And by the way, Gina, not to make you not a competition or a winner today, but you've had some really good questions. I appreciate that. And you made some good observations. This trade that we just did is focused on the implied volatility collapsing. But that's not the only thing that's going on. We can actually do a version of this trade which is the totally opposite direction. In fact, there's a number of versions of this trade. So let me jump out to something else. Let's see here. I'm trying to find something that gives you a really good feel for what's happening. This is pretty good. I'm going to use the left-hand side of the chart because it's a little bit more clear. But implied volatility around earnings announcements, or once again around any risky event at all, has a very, very distinct pattern. And if you take a look at implied volatility in the chart, you can see it. It's literally almost a heartbeat. Bump, 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 bump. This looks like an EKG. It looks like a nice, consistent, healthy, heart rate. Now, over here, you probably ought to be cutting down on the salt and the fats. This does not look quite as healthy anymore. But the point I wanted to make is that these patterns consistently repeat time and time and time again. And it's not all about the collapse. We can actually play the exact same idea on the rise in implied volatility. So let's take a look at that. Actually, I had a note on, let me see, which symbol was I looking at? Walgreen boots. Let's see. All right. Here we have Walgreen boots. All used to be called Walgreens, and then some private equity people bought into it and did a bunch of stuff, and it became the silly name of Walgreen Boots Alliance. Anyhow, we are currently a ways away from the earnings announcement. In fact, their earnings is going to be on April 4th. So we're a little bit more than a month away from the earnings announcement on Walgreens. Implied volatility, moderately low. By the way, this market might be a great time to be doing this style of a trade. But this could be the pre-earnings season that we're getting into might be just about one of the best pre-earnings seasons we've ever had because we are starting out so low. We know that as we get closer and closer to the earnings announcement, Walgreens earnings announcement, we are going to have implied volatility going up on the options that expire after the earnings announcement. Now, there's some tricks to this trade, and there's some things we have to be careful of. It's not exactly the same as the earnings trade, but we can actually create a trade that does very well based on this. So let's assume that our tool is going to be a strangle, and you wanted to make money off of implied volatility increasing. What would that strangle be? Would it be a short strangle, or would it be a long strangle? Paul, will this trade work with TLT bond going into the Fed rate increase? If there's a consistent pattern of implied volatility into that, absolutely. Yeah, that could be great. You want to test out and make sure that the pattern of volatility increases there. That's what you're trading. So long. Excellent. Got a bunch of answers there that were dead on. We want to use a long strangle because a long strangle has a lot of an effect. It increases in value a lot from rising implied volatility. Okay, good. Which option expiration relative to the earnings announcement is going to see the greatest increase in implied volatility between now and the earnings? Yep, Doug, you said exactly. You want to buy the volatility. Now, which expiration would you use? Because it would have the greatest increase in implied volatility. Some people are missing on this one. By the way, there's a lot of presenter only, organizer only, and private messages. Everybody's saying the week before, week of expiration, 3 months out. No, you're all missing it. Come on. The answer is you want to buy long the option that expires immediately after the earnings announcement, because that's the option that is going to see the greatest amount of implied volatility. So the difference between where the implied volatility is now and the implied volatility on the option that expires immediately after the earnings announcement, leading into the earnings announcement, that's the slope that you're going to be trading. So let's play around with this. First of all, I said that there's a couple of tricks relating to this trade. And by the way, this is what I would typically refer to as a pre-earnings volatility trade. The last trade we did was an earnings volatility trade. Pre-earnings, we're playing the rise in implied volatility. Now, to do this trade properly, there are some risks you have to accept. One of those risks is we are going to be doing the trade far enough out that we won't know for sure the exact date of the earnings announcement. And that does represent a risk. So I'm going to ignore that risk first and assume that we know a perfect answer for the date. And then I'm going to talk about how we can, basically deal with the risk around not being sure of the exact date of the earnings announcement. Paul, I'll tell you what, I'm not going to just say it, I'm actually going to show you exactly what I mean. So let's walk through this. In this case, I want to buy options that expire immediately after the earnings announcement. The earnings announcement is April 4th. So let's go to the book and look for, hey, right there, April 7th. So I want to create a long strangle that expires on April 7th. Now, currently, those have a 22% implied volatility. Let me see here. Yeah, that's pretty good. See, what we're looking at right now is the average implied volatility. You get 22, 21.9, basically 22, 22, 21.33, 20.87, 23.41, 23.55. There's a little tiny bump in here because most people know that this one should be after the earnings announcement, but it's not big. You'll notice that this is all fairly level right now. Perfect. That's when we want to be getting into this. So I want to create an April 7th expiration, long strangle. I'm going to buy a long put. By the way, these are not the strikes I'm going to use, and I'll show you why in a second. I'm just going to randomly do an 85 long put. and I don't know, 87.50 long call. It's a $3.95 debit giving me a long strangle. Now, there's some great things about this. Vega, I've got 11 cents in Vega on one side. I've got about 11 cents in Vega on the other side. That's 22 cents. Every 1% this trade increases, or the implied volatility increases on this set of options, I'm going to get 22 cents worth of value. That's actually quite a bit on a $3.95 trade. So what is 22 cents? Divided by 3.95. That's a 5.5% return for every 1% increase in implied volatility. That's damned good. It's really good. But the reality is that's not enough, or at least not by itself. Because at the same time, every single day that we're waiting for that to happen, for that 1% increase to happen, I'm losing 3.2 cents on one side from theta erosion and 3.2 cents on the other side. So I'm losing 6.4 cents per day over potentially 38 days. Actually, it's going to even be more than that. This is going to erode to zero if I don't have implied volatility going up fast enough. So implied volatility going up is going to benefit me, but theta erosion every single day I'm holding on to this is going to hurt me. So that's something I've got to deal with. Now, how do I make that go away? Now, I don't need to take an opposite trade on this one. A long strangle is perfectly fine. I mean, I could leave this on as a long strangle if I felt like, and that would be fine. But that theta erosion makes it very, very difficult to make this trade work well. You know, it's something to really fight. You know, it's going to be, beating that is going to be hard, even if we've got rising implied volatility. Now, the rising implied volatility will help out a lot, and it will improve things a lot, but it's not going to be enough. So let's get smart about this. We chose these long options because they expired immediately after the earnings announcement. And they are going to be the ones that have the greatest increase in implied volatility. But we've got this problem with theta erosion that we need to have go away. What other options are there that are not going to be affected by this earnings announcement? So, quick quiz. Which options that exist right now in this whole series are not going to be affected by the earnings announcements? The one that ends the week before. There you go, Gina nailed it. So let's take a look at this from the Greeks, because I always find this to be really interesting. I'm going to use the same strikes. The strikes at this point didn't matter anyhow, but I would have a theta erosion of, let's see here, of 6.4 cents a day. That's basically 0.032 plus 0.032, 0.6 or 6.4 cents per day of theta erosion. But for every 1% increase in implied volatility, I would get about 22 cents worth of positive winning volatility. Now, if I jump back, let's see, 85 and 87.50, and use the 31 of March, and I sell short 85, 87.50, this, and this. Now, in this case, I would get hurt by a rise in implied volatility on these options. In fact, I'd get hurt 10 cents here and just about 10 cents there. I would get hurt by about 20 cents Now, the long options are gaining 22 cents, and this one would get hurt by 20 cents if implied volatility went up by 1%. At the same time, I would have theta erosion. This is a short strangle right now. Theta erosion of 3.1 cents here and 3.1 cents here. Now, this is where things get really interesting. I'm gaining a value of 3.1 cents on each side, so that's actually 6.2 cents. So if I'm losing 6.4 cents per day on the long options and then gaining 6.2, the net difference is I have suddenly dropped my theta erosion on the overall trade to 0.2 cents per day. So I've got my short option making me money from theta erosion, my long option losing me money from theta erosion. If volatility goes up on the long option, I gain 22 cents per 1% change in IV. If implied volatility goes up on the short option, I lose 20 cents per 1% in IV. Now, I want to see people thinking on their feet here. What makes that so amazingly good? And I'm going to say focus on volatility. Think about this. What's really going to happen with the volatility? Right, if volatility goes up, we make money, but think this through. Where is the volatility going to go up? Remember, we've got one option, which is our long option that expires after the earnings announcement. It's going to be facing the full brunt of whatever happens to that earnings announcement. But the option that expires before the earnings announcement, which we would be losing 20 cents per every 1% increase in implied volatility, expires before the earnings announcement. The one that is the long option goes up in implied volatility, but the one that's the short option, which would have hurt us, doesn't change. So what we just did was we got rid of almost 90% of our theta erosion and did not hurt us at all for the theta or for the vega, because the short option isn't going to go up in implied volatility. It expires before the earnings announcement. It's done. No real risk. The long option, though, which helps us, basically is going to be exposed to a huge increase in IV. So what you have is we just got rid of all of our theta erosion problem that made the first long strangle bad, and we left all of the positive volatility of the whole thing. And then there's a second bonus to the thing. We just took a trade that initially would have cost us, let me see here, 85 by this, would have cost us $3.85, 90 cents, somewhere in that area. I don't know, some just short of $4. That's what this initial long strangle would have cost us. And we turned it into a trade that's 97 cents. So the cost, the money that we put into this trade to get the equivalent of a 22 cents of exposure for a 1% increase in implied volatility dropped down to 97 cents. So this right here ends up being an extremely interesting trade. We just got rid of our theta problem, kept the volatility, dropped our cost to trade, overall created a pretty interesting little trade. Now, there are problems here, and so just don't think that this is perfect. Your biggest problem is, number one, you're going to have to be in this trade over a fairly long period of time. We would be selling short the option a week before the Friday that expired the Friday before the earnings, and would probably close the trade out entirely during that week, which in this case means that we'd be holding on to this for about 25, 26, 27 days. If the stock moves a lot during that period of time, we could have a problem with the stock going outside of the range that we want it to work in. So we need to figure out what that safe range is. Number two, and this is probably the biggest of the problems, companies do not confirm their earnings dates until usually 2 to potentially 3 weeks before the earnings announcement itself. We're getting into this trade 4, 4.5 weeks before when we speculate the earnings announcement will be. If for some reason they change their earnings date outside of our date range, it can turn this trade against us fairly quickly and hurt us. We want to be very careful of that. So, are you seeing the general concept here? Once again, I want to know that you're following the idea. We're using the implied volatility going up and hedging it off with basically a short option that's not going to change. Let's take a look at this real fast. Now, let's see. Here is the trade as it looks right now. Now, this is the interesting thing. This trade looks pretty good, looks okay as it is. Let me just get that there. Okay, there we go. Get these out of the way. So let's just look at it clearly. In fact, break-even point is about there and there. Now, funny thing is that this is not taking into account any adjustment at all on volatility. Let's take and put an adjustment on volatility. To do that, I need to get an answer. What was the implied volatility of the option that expired the Friday after the earnings announcement on the Friday before the earnings announcement? So just going to use think back once again. Just going to grab a couple of samples. Let's see if we can get an answer. We've got 1/5, January 5th. We have October 20th. And here we'll do one more, July 6th. So we just put ourselves in the same place on this trade back in time. First one, January 5th. So if the earnings announcement was on the 5th, we would have been exiting the trade on the Friday before that at the latest, because that's when the short option would expire, and we would want to know what the implied volatility was on our long option, which would have been expiring on the 6th. Let's see, I got to jump back to December. Hold on. I need to pay attention to what I'm doing. It's getting too late. Come on. Ah! Great. January 5th, 2017, back to the 30th. All right. Here's the option that would have expired the Friday after the earnings announcement. Its implied volatility was hitting about 38% on the Friday before the earnings announcement. Let's just say 37%. Go back in time again, October 20th. We're looking at the Friday beforehand. We're looking at the options that expire in 1 week. Implied volatility is about 34. So we'll say 34%. And July 6th. The Friday before that, the options that expire in 7 days, 43. Okay. We've got 37%, 34%, 43%. I'm just going to go relatively conservative and just say 35% is our target. Not quite the lowest one. I could have gone and looked at more samples, but I want to kind of do this relatively quickly. The short options, we don't care about at all. They're expiring. These are going to be gone. But these options right here, 22%, 23%, those are going to move. My speculation is to about 35%. So let's just add 12% IV to this. So the 31st of March, excuse me, the April 7th, I'm going to add 12%. Boom. There we go. That right there looks damned nice. You see how adding that implied volatility, remember, my samples were 37%, 34, and 43%. I'm sure if I went back, I'd find more samples up around the 38 and 39%. I'm being moderately conservative here. I'm not even going nuts on this. This is down at the lower end of my sample range. If I hit that IV, this is what my P&L could potentially look like. My break-even points are about 82.70 by 89.97. Let's see, so it will be about here, and 89.97 by about here. All right, so we'd have a range of about here to here. It's a little tight. This is one of the challenges that you get into on this trade, is do you want to hold on to the trade over that period for that tight of a range? There's a whole bunch of ways you can modify this trade. And I think I'm going to actually wrap things up. We're at 10:30 right now. We've been going for 3.5 hours. As we trade in the ALTB, we're going to be doing these, and there's a whole wide variety of different ways that you can deal with it. But the trade itself is fairly straightforward. You set it up, you evaluate it, you determine the range you're going to be dealing with, and you basically create a trade that makes sense for you. Now, actually, in this case, I did something a little bit wrong. In fact, I'm sorry about this. I should have done one other thing. That is, take a look at the strikes here. I'm going to be exiting this trade on the 31st of March. There's a built-in implied volatility range, or a market maker move range, of $4.22. I would choose my strikes based off of 86 minus that. So basically 82 and 90.50. Can I do that? Yeah, 82. Oh, well, okay. Here's why the trade would have been better. We would have used much wider strikes, probably 82.50-ish or 82 by 90. So let's redo the trade slightly. Sorry, it's late. I'm going to use 82.50 by 90. This is just a little on the inside edge of that one standard deviation range. Actually, we probably want to go in a little narrower than that. Okay. That's roughly where we would want to be on this trade, which would also move our break-even points out to 91 and down to 81.69 or 81.70-ish. So, questions on this particular version of the trade? Thoughts, ideas, criticisms? I'm too damn tired to think anymore. Can everybody hear me? Because did I lose everybody? Thank you for answering, Gina. I appreciate it. Okay, so you just got exposed to trade number 2. We will be exploring these more and more in live trades in the classes as we get closer. This is about the time of the year where we're going to start to work on these. In fact, Walgreens may be one of the trades coming up. There is a different way of dealing with this, though. You don't always get a nice sideways channel like this. Sometimes you're dealing with something that's more directional. Well, it actually works. All you would do in that case is make it a directional trade. Remember the calendars we did, like the STX trade? If you straddle an earnings event with one of those directional calendars, like a bull call calendar or a bear put calendar, you can do the same thing and add in the advantage of an increasing implied volatility to make the trade better, and then just treat it as a bullish directional trade or a bearish directional trade. Whole wide variety. In fact, I'll be honest with you, my goal is to teach you the ideas and show you the different trade styles and open your eyes, but we could be here for the next 6 weeks going over all the detailed, versions of how you could do these. But this should give you some direction as to what some of the possibilities are. And these are all very usable, very profitable trades in general. What do we have for questions? TOS Live doesn't show this as a viable trade. Why not? Oh, you know what? Not traded. Sorry about that. I need to pay attention to the strikes. By the way, I was just jumping around on the strikes to try to tweak things. Whenever you see this pop up as not traded, what I probably did was set this to a strike that was not available. It doesn't mean the trade idea is bad or anything like that. It just means that one of these strikes just didn't exist. Let's see, the 7th of April, 89 and 83.50. Let's see, 7th of April, 89, 83.50. Okay, those exist. The 31 of March, 89 and 83.50. There we go. The 89 strike doesn't exist on the 3rd of March, so we'd have to move that to 88.50. 83.50 does. Not a big deal. It actually doesn't radically change the trade too much. It would, by tightening it up, it would increase the center profitability, and it would slightly reduce the width of the trade, and that's all you would have to do to change it. Yep. So that was the problem right there. So what is the overall cost of this trade and the profit? All right, let's take a little look at that one. The cost of the trade, if we change these, let's see, 88.50, 88.50. Cost of the trade here would be a 90-cent debit. So we're effectively trying to sell this for more than 90 cents. Without getting into sizing or anything like that, the cost of the trade is about $900 for 10 of these. If we were to hold on to this trade and get a decent, reasonable profit in the middle of this, let's see, we're looking at about $500 profit on a $900 cost on the low point in the middle. That's if we hit the center. We're actually better off if we are closer to the peaks. So in those cases, we're about $900 to $1,000 profit. These are about 100% returns over here. This is somewhere around a 60% return in the middle. As long as we kept it in that general range, we'll be doing pretty darn well. There's lots of room to make a profit. As a matter of fact, I would probably not shoot for that. I would probably shoot for a far more conservative profit of, say, 30% and basically take the early exit on the trade. Let's take a look at something about how this trade develops. This is always hard to show off. It's almost impossible for me to show this off. We're going to just have to assume that the implied volatility is going to happen. But watch the way that this purple line develops. I can't. Dang it. All right. What's really going on is over time, the P&L is going to increase in the center. It's going to be a rounded hump. There's a point where we can be making a trade to exit this for maybe 30, 40, 50, 60% profit across a very, very wide range. Finally, in the last week of the trade, the P&L in the middle drops down, and the P&L in the edges near the strikes goes up. You need to be paying attention to that. You don't want to get caught having a good P&L in the middle late in the trade and then have it disappear in the last few days. So we'd want to be conservative about that. Ideally, I would actually just put this in at about a 30% profit, which is a reasonable fraction of what the max profit is, and let the trade work its way into that situation where we're making money there. I wouldn't be swinging for the fence and trying to hit the perfect trade. So overall cost in this situation is a 90-cent debit. If I was looking for a 30% profit on this, which is far less than our expected max profit, we would be getting, see, 90 cents plus 8 cents to cover commissions times 1.3, closing it out at $1.27. All right, I do need to wrap this up. We are incredibly late right now, and I think I'm getting yelled at, to be honest with you. Nope. Had a message, but it wasn't from Wiz. Okay. Before we wrap this up, final questions here. Do you feel like you got something decent tonight? And just so everybody knows, these are trades that I do actively use. We are going to be doing these in the ALTB. For those of you who want and you want to take it further, the Wingman Group Coaching Program, love to have you involved in that. If anyone would like to talk about that, definitely like to get your name up on the list and I'll reach out to you. But these are trades that we will do in the ALTB class, and you will see them live, and we'll manage them and basically show you the ins and outs of how they all work. But right now, we are wiped out. Thanks, everybody. Jamie, Chris, Giles, Gina. Anything else before we finish up? Going. All right. Two final things. Thursday, we are going to have, by the way, this is the last of the trade-oriented classes for Full Throttle. Thursday, we're going to be having the wrap-up session. Now, the wrap-up session is kind of a discussion about a whole wide variety of topics, different ideas, different things about managing portfolios and trades. A lot more just an open, kind of free-flowing discussion about trading and answering any questions that you might have built up over the series. We're also going to have a full question and answer session. So if you've got questions or anything that you don't feel like you understand clearly during this series, bring the question and we will talk about it. That's what Thursday is all about. We're going to cover some basic topics, but we're also going to be making sure everybody walks away from this feeling satisfied that they learned what they needed to learn. Now, that will wrap up Full Throttle. Does anybody have any questions about the Wingman Group Coaching? I'm not so much the salesperson, but I will definitely answer questions and tell you what it's about and help you figure out if it's right for you or not. Anybody have any thoughts, questions, curiosity, anything like that? Chris, are all these classes available in the member area to review indefinitely? Yes. At least in my experience, we have never taken a recording down. There's still recordings from many, many past Full Throttle sessions. Once we put them up in there, we pretty much just keep them there. And also, remember, if you came in to Top Gun for a Full Throttle series, like you're in right now, in another couple of months, we're going to do another Full Throttle series. Just pretty much what we just did over the last 7 sessions and into the next 1 session. You are absolutely welcome and encouraged to show up for those. I've got people who are coming for their second, third run through of this session. You're not charged anything else. There's no extra cost. Once you're a member and you keep your membership up, you stay on as a member, you have access to these every time we do them. So you've got the recordings and you're going to have the opportunity to do them in the future with us live. So look forward to seeing all of you back. Now, did anybody have any questions about Wingman Group Coaching? Because I can take a couple minutes and answer those if you want. Does everybody hear the crickets behind me? I'm actually hearing crickets right now. All right. For those of you who are interested, the Wingman Group Coaching Program is one of my favorites. It is something that I enjoy doing a lot. It fits some people, it doesn't fit others. It's a more aggressive program. It's a small group of people that I do a lot of hands-on work with. And, you know, it's me having the chance to really understand what each person's needs are and kind of push them along the road to become a better trader. It's not entirely one-on-one. There is a small group that we're all working with, but within that group, I'm dealing with everybody as a person as opposed to a 100, 200 person group. And I can do a lot more interaction with everybody. We set it up around the idea of trading a portfolio like a hedge fund. Depending on the group, that has veered off from that at times, and other times we've pushed that idea really hard. It gives us a chance to give everybody different roles to professionally manage a portfolio, teach you the skills and teach you, the hands-on management of the portfolio as we go forward. So anybody's interested, reach out, we'll get you on the list. And the way it works is this. You sign up for the interview, you and I have a discussion. There's no cost associated with this, but I will call you and we will have a one-on-one talk. I'll tell you what we do in the program. You ask me questions. We talk about the skills you've got. We'll figure out if it's right. And if it's right, you can decide to join up. We take about 10 people. So there you go. What do we have? Well, Chris, if you don't know what your needs are, we can certainly talk about it. I'm not going to force you into the group. And this talking is usually a pretty productive thing. So if we can talk it over and see what you want to do, I'll give you my best answer as to whether or not it's going to benefit you or not. So that's the best I can do. How many days a week do we trade in Wingman? Paul, this is the way it works, is we have a group meeting, usually about 2 to 3 hours each week, where the whole group works together. And by the way, it's not like this where you guys are typing into the chat box. We actually, since it's a small group, we actually have the microphones on, and it's like a conference call. We're all talking, we're all exploring ideas, trading thoughts, trading different experiences and things like that with each other. And in that group session, we all work on certain skills that we need to build, and we also work on a plan for what we're going to be doing. It's beyond just the group. It's beyond that one session. Everybody is actually doing trades within a portfolio for the group. And you're managing different positions, you're looking for different risks, you're identifying different trade opportunities and actually contributing to the group portfolio all together. Periodically, we'll have people team up and do, manage a group of trades as a pair. Other times we'll give different roles to people. One person might be an overall risk manager who's in charge of identifying broad risks to the portfolio. Another person might be somebody who's in charge of identifying, creating a list of tradable targets. We cultivate those roles and those tasks to each person. Basically, if you're not good at something, that's what I'm going to be pushing you to do, because I need you to get good at that. And as you go through the program, you're going to get exposed to all of the different roles and get pushed to learn the skills to do different things. And then when you're done, you have those to apply to your own trading and your own portfolio. Ideally, as we work together, you also get to be a bit of a team and learn to work, to share ideas and things like that. So it's good. It's a fun process. But, people should be, willing to put a reasonable amount of time. I'd say that I would expect about 8 to 12 hours of a week overall into the program. More if you want to get more out of it. You could probably slack off some, but I will start to jump on your butt and get you moving at that point. It will vary a little bit over the course, but that's what I would generally expect. The program is over roughly 10 weeks, and it includes, I believe we have set up 3 one-on-one sessions, which means individual discussions about your trading and your, talking about your particular trading issues and needs directly with me as a coach, and then the rest of the sessions are group sessions. So it's basically a 10-week program. Chris, what time of the day? It depends. Since it's a small group, what we typically do, and this almost always works out, I've never had a problem with this, is as I'm pulling the group together, we decide what works the best for all of us. Right now, we're meeting at 1 o'clock on Tuesdays, and we usually meet for about 3 hours. And we're wrapping up the Wingman Group coaching session that we've got going right now. So that would actually be changed to whatever fits the group. Usually, to get the most out of the sessions, we do like to do it during live trading hours because we are working on trades in the market. So my expectation, it would be sometime during trading hours, Monday through Friday. Outside of that, we'll pick whatever works the best. What are the questions we have? Don't leave me with the crickets. So Chris, did that answer your question? And Paul, did that help? I know you were interested also. We've got a couple of the people that we've already got interested in taking the program. So we'll start to reach out to everybody and talk to everybody on a one-on-one basis. Will this run every 10 weeks? No, absolutely not. The way that this works is we basically find a period in time when we've got enough people actively involved that we can create a solid group. And we only run this when we can create a solid group. So I can't promise you when it's going to happen next. We've got a lot of people in now, and that's good. It means that we are finishing one up and we're moving into the next. But that's not always the case. So this is not on a strict schedule of any type. It's really when we have the critical mass to do it well, we do it. Chris, I mean, everybody's going to have conflicts here and there. Working on Tuesday and Thursday, that's not a big deal. It gives us 3 days. I've never had a group where we weren't able to find some good time to meet. So I wouldn't worry about that too much. That's not a real problem. All right. Anybody else? Chris, did you have any more questions? Paul, have a good night. Anybody else have any thoughts, questions? Anything you wanted to know? Well, then I will say good night. Thank you, everybody. Appreciate it very much. And I will see you on Thursday, and we're going to wrap up the Full Throttle. You guys have been great. By the way, I really like having the good questions going. So excellent. Keep it rolling. I'll talk to everybody later and get some sleep.